contrarian, leave it to contrarian badass Reggie Middleton. He called the housing crash. He called the collapse of Bear Stearns and Lehman Brothers and the crisis in the Eurozone banking system. Reggie Middleton.
We're taking the research and we're tokenizing research. Okay, we have a token offering ongoing, started on the 25th. But unlike many other token offerings, I guess they're calling them ICOs.
You said that it's access to the software. It's the software as a product.
Right. Well, it's actually more knowledge as a product. Knowledge as a platform. Okay, and the knowledge is being
interesting. So how do you quantify, for the purpose of the token sale, the knowledge of the platform?
So we're creating a software vertical. Think of the DAO. Okay, that DAO will contract out to us for our research. Okay, and when upon demand, we'll give the DAO the research, and the DAO will investigate other token sales in other platforms. So let's suppose the way we and the DAO calculates the risk-adjusted return of Ether or Bitcoin, and that risk-adjusted return, right, it's higher than risk-adjusted return of any competing potential assets, S&P 500, LSC, other tokens, etc. Okay, it will elect to buy those tokens. Okay, those are platform tokens on platform level.
So the machine is deciding what to buy based on calculations of risk-adjusted return?
Right, and the machine is autonomous. The machine is not us. The machine will run on its own. Okay, on top of that, that's platform selection. It will also invest the tokens of entities such as Gnosis and Economy and Augur and whoever else. And it goes through a rigorous analysis. There's but so much that the smart contract logic can, digest at one point. That's when it contracts out to us.
You're placing a lot of confidence in the capability of this machine to make decisions.
No, actually not at all. We don't think so, because the initial decision is relatively rudimentary. The higher stuff is when it hires out to an outside firm. And of course, since we built, the machine, we would be the outside firm. Okay. We are able to do very, very high-end analysis. Okay. And, if you want, during the, I could send you a link to some of the stuff that we've done, like when we, the Bear Stearns call, etc. We've outran all the street, the rating agencies, etc. We're going to take this same team and we're going to apply it to the token market. Okay.
But is the machine deciding what to do, or is it just you guys with your high-end analysis deciding, and then the machine takes your input and does it?
The machine is going to do exactly what all other non-synthetic entities in the space do. The machine would be like a synthetic hedge fund, okay, a synthetic private equity, but it's going to be software. It's not going to be an actual, entity. If you go to a hedge fund, most mutual funds do not do their own analysis. They, either buy it or they get it for free. Of course, you get what you pay for, so you have to be careful what you get for free. So they go to research entities, they buy research, and research entities recommend XYZ, and then the fund itself, decides whether they act on the research. But if they rarely do that level of research on their own, okay.
Well, you know how the machine works, right? So you had a hand in controlling how it works, writing the software for it, probably have ongoing relationships with it. Your input basically determines what the machine's going to do.
Well, not necessarily. You create an algorithm, help the machine decide yes or no. We'd like to make the machine become more autonomous and independent, but, one step at a time. But, and I want to reiterate, this is absolutely no difference than the status quo. Okay. The way it's done now, a hedge fund wants to buy research on, let's say, economy. Okay. Most hedge funds have absolutely no idea what Ethereum is, talking about, a company built upon it, etc. So they go out to an outside research firm. Okay. Now, the biggest difference between this machine and a hedge fund is this machine is a robot. right? It doesn't have an asset manager. It doesn't have a hedge fund manager. It doesn't need 20, 25%, 30% promote fees. A promote fee is a success fee. So let's suppose that the hedge fund and the machine invest in the same thing. They have a very good year. Their assets go up 100%. Okay, the hedge fund is going to take 30% of that gain and 2% of all the assets in the pool, which could be very expensive. The machine takes one flat rate, just enough for it to keep going. So it basically operates at break-even level, okay? Because there's nobody to pay except for its contractors, and we'll be the contractors. We have a development team and a research team, okay? Now, when you have a machine compete against humans, okay, at the same level, and the humans get paid a lot of money, the machine, by supply and demand, should outperform significantly. If you watch, I can send you the math. I can send you a link to it. If you go to Veritaseum.com, there's a long article that I did. And basically, the machine will be approximately 90% cheaper than a typical hedge fund at 2.5% assets in the management, 25% on the incentive fee.
What you're getting at is there's a major disconnect between a lot of the sort of high-end, high-finance financial sector and the crypto kind of sphere. These hedge fund people don't necessarily know about crypto, and the crypto people almost certainly don't know about how hedge funds and such work. Right? You're basically why don't we just apply this to that?
Well, I'm taking the hedge fund model and I'm applying it to the crypto universe, but I'm taking advantage of the full all the qualities available to the crypto universe. When you take full advantage of it versus trying to replicate, a legacy model, things look very, very different. I think most entities want to replicate the legacy model. So they want to take the blockchain and they tokenize things and they say, well, we're going to create a hedge fund or this fund or that fund. This is really not even a fund or an investment. This is interactive dynamic research. If you go back to, say, the 1970s and Wall Street, and if you take a look, I'm here now. So I'm sitting here right at Hedge Fund Row on Park Avenue, okay? And I'm surrounded by hedge fund guys. So if you take the 1970s model, banks were partnerships, okay? So they risk their own capital to make money. That put a constraint upon the amount of risk they were willing to take, because if you took too much risk or the risk-adjusted return was too low, you lose your own money. Post-1980s, the bankers' trust area, early 1990s, these banks started going public, and they took their partnership units and they sold it to the public in exchange for stock. Okay, in exchange for money. So they made stock out of it and sold it off. Now they're not gambling with the house money; they're gambling with clients, with investors' money. That's when the risk curve went from here and spiked up significantly. And that's when you had the Bear Stearns and Lehman's. If you really know the business, it's not hard to predict their fall if you're objective. Okay. At the same time, a significant portion of all finance is research. Basically, you have to know what you're doing, whether you're trading, investing, borrowing. You have to know your research. Research is not very well valued at all and respected. Often that research is given away for free if you do business with a bank. So the bank is more willing to do transaction revenue than actual advisory and learning. When you do that, you make perverse incentives, and these perverse incentives cause the researchers to become marketers and salesmen versus actual providers of knowledge. We're taking that model, we're going to take that model, we're turning it totally upside down. Now, the value add is the research. Everything else will be given at cost, if not below cost. So instead of making money from trading fees and commissions and S fee and B fee and BS fee, if you know what I mean, we will give most of that away for free because the blockchain is relatively inexpensive. And the only thing we'll be charging for is the actual research, the knowledge, the advisory as a group.
So why don't hedge funds or other sort of institutions do this kind of model? Because you could theoretically do this, not taking and not charging this fee and just getting further research. Why doesn't that happen presently? Is there some reason why that can't happen?
Because most of the money in the current culture is in transaction fees. Okay. And if you're paying for research, then you would expect to get quality research. And then that's when you have to separate the wheat from the chaff. Okay. Then you have to give, real credible advice versus just putting out 30-page PDFs every week, which most people don't read anyway. It is our hope desire and our prediction that this model will catch on, because if you remember, there's an E.F. Hutton, which was an old brokerage firm, and used to be a commercial on TV, and they say, well, we make money the old-fashioned way. We earn it. If this catches on, then our research tokens, okay, which we're selling as software, not as an investment, will increase significantly in value. They increase significantly in value not through speculation, but because the inherent value has increased significantly. Okay, this is again going back to the original credo of the Veritaseum and what we do, peer-to-peer capital markets. We're allowing any entity, person, or corporation to deal directly with any other entity, person, or corporation without the middleman. Okay, we give pure value add and take everything else out.
Yeah. So the analysis of the trends and the research and figuring out what's going to happen, other people all over this decentralized network will have a need for it, as opposed to these big centralized hedge funds.
Right. And, you know, you drop the cost, you could get in as cheaply as buying, you know, one token, you know, $2.90. And, you know, we'll probably factor in where the crowd can add their own research, or their knowledge, shall I say. But that, you know, is into the future, because informing this contract is going to be, you know, hard enough as it is. We will try very, very hard to have an alpha version of this out by the end of the actual crowd sale. We're working. As it is right now, I don't hate calling them ICOs because it sounds like, you know, IPOs, and that's going down the wrong path. Most offerings are basically a request for funding to deliver something in the future. So we came a little differently. We have an extant beta code base. It's been running for years, right? Available right now. We pulled it from public access due to potential regulatory issues. We have several patents pending, and we're going to have the next product service hopefully available by the end of the token offering. Can't promise that, because you know how software development goes. You know, it doesn't really adhere to anybody's schedule. But the alpha will be available very quickly, and we're going to make it work. Once this is done, right, and once we get it going, it goes out alpha to beta to actual production. Okay, these software verticals, we're going to build one for every single industry. Okay, insurance, healthcare, everything. Basically, cutting out the middleman, allowing Peter to deal directly with Paul, with just the value add being charged for. And then we contract out to the value add where the machine can't handle it on its own. As time progresses and machines become more capable, then the machines will do more until we get to the point where it's AI Terminator Skynet style. Of course, this is Skynet for Wall Street, the sell side, not for everybody. So, you know, Skynet, Terminator,
Yeah, they're not
I got you like that.
They're coming to take your jobs.
Automation is doing it anyway. A lot of people, you know, this current administration, he campaigned upon labor force or jobs leaving because of immigrants and China and Mexico. Automation is taking much of the laborious repetitive labor. Okay, a lot of laborious repetitive labor is not blue collar. A lot of it is white collar. Okay, even if you're an analyst, a machine can sit there and run numbers on an income statement, the balance sheet. You have to have a value add. Okay, if you don't have a value add, you know, the ability to do simple addition and subtraction with a couple of multiplication problems is a machine like that. And we're going to prove that.
So you mentioned the effect that a lot of the stuff that happened a long time ago of switching from a partnership to corporation had on the financial industry. The decentralization is going to have effects that we possibly could predict in retrospect?
Well, we're not shooting and I'm going to answer your question just one terminology. We're not shooting for decentralization. We're shooting for full distribution. You know, think of centralization where things are decentralized, or can you break up a few of the banks? Now we have 30 nodes versus just one. We're going for this full distribution, you know, 2.5 million nodes or more and counting and growing. You know, the network effect on full blast. Now, whether going from centralization to decentralization or to full distribution will have an effect, of course it will, because what you're doing is you're dropping margins. Margin compression is part 2 of the business model of Veritaseum. We can't compete on pure horsepower. We're never going to compete on capital. You know, we're struggling for raising small amounts, but there's a structural deficiency in Wall Street, and that structural deficiency is found right on the income statement. Between 35, usually 50 and 60% of gross revenue goes out to compensation. Right? A layman's way of saying is they pay their people too much. So as an investor in an investment bank, you don't get paid until after the traders, the investment bankers, and the other MDs get paid, and they get paid 60% of what should be money that comes to you. Now, a lot of investment banks have tried, they realize this because they can do math, and they've tried to lower that fixed, which is supposed to be variable, but it's basically fixed from a cultural perspective, compensation. But every time they do it, if Merrill Lynch drops their compensation, then all the star players, the actual key quality inventory, runs over to Merrill Lynch or Morgan Stanley. I call them inventory because banks don't really do anything besides have smart people that push digital, bits around. They just like this smart contract machine. Okay, so their only real inventory is human capital. That human capital is overpaid, but the culture is overpaid. So if one bank tries to do it, they lose their inventory, which they can't afford. Two banks try and do it, then they lose their inventory. You need the entire industry to concertedly drop the cost. Never going to happen on probably the most competitive industry in the world. Okay, we call that a structural deficiency built directly into the business model of banking. Right, zero margin machines will go directly to that structural deficiency and cut its legs off. Very difficult to compete with.
So here's the thing, though: the type of analysis that they're doing is still going to exist, and it's probably still going to be done by people. You're talking about the research and contractor type relations. They're still doing that analysis, right? Like they're still doing the brain work to figure out what to do.
Well, they are, but let's walk through a realistic example. Have you ever bought a stock or bond? Or
yeah.
Okay. What research did you get?
Well, not terribly much.
There you go. You've answered your own question. You see. Now, you may have gotten research, you didn't read it. The research that you would have gotten, realize, is not to benefit you per se. It's to benefit the economic income streams of the bank. So, and I'm not going to name a bank, any particular bank, but we run a hypothetical, a devil's advocate hypothetical. So, a bank called Silverman Blocks, or Silverman 6. Okay, no, not Goldman Sachs, Silverman 6. Okay, a bank called Silverman 6 has a large inventory of Green Book stock. Okay, not Facebook, but Green Book. This is all imaginary. Okay, they want to get rid of that stock. So coincidentally, their analysts say buy on Green Book stock. Now they get retail investors and other institutions who may not have the benefit of the Veritaseum robot machine to buy that stock. Now they've gotten rid of the inventory they didn't want. They want to gain inventory. Let's say they want something like Microsoft. Okay, it's all hypothetical, never Microsoft. Microsoft, don't get it confused.
If you're in a institution, those analysts are considered to be very knowledgeable and reputable, and when they make a buy recommendation publicly, it has a very big effect on other people's decision-making process. That's what
that and or they are basically the marketing sales team for the sales team. It can be argued, because I don't want to be accusatory, it can be argued that instead of being truly independent, okay, they work in concert with the rest of the company, which would make sense because the traders work in concert with the rest of the company and the salespeople and everybody else. The only way to assure that that's not the case is to have the research arm not be compensated in any way, right, by any of the transactions. That doesn't happen, okay? And the fact they don't charge you for research, it might seem like a good deal, but back to you get what you pay for. If you're not charged for the research, how's the research being compensated for? Or being compensated? So, that's that question.
What you're suggesting.
Excuse me?
They're making a strategic move when they make you a recommendation like that.
Yeah, there's something behind it, Notice how every time someone does an underwriting, they have a research cover that company. Transaction fees, the transaction revenues and advisory revenues should never come from the same entity. You can't, there's a conflict of interest. You can't trust them. Listen, I'm going to sell you a bridge, okay? I happen to have a bridge agency, right next door. You're both going to work with you.
Okay. So I think that the other thing that may happen with a distributed system of this kind, right? I mean, decentralized and distributed, I think, are kind of similar. We're talking multiple things. We're talking full distributed system. But when this has happened to other sectors, you have gone from a totally small number of professional of people into a large number of often very low quality people. For example, journalism. 50 years ago, professional journalists was a respected profession. They were well paid. There was sort of a public service ethic even among journalists. Online, journalism is available to everybody, and everybody participated. But it had the effect of journalism is everywhere and it's free. And the professional journalist had a very difficult time competing with crap, right? And this may happen in other areas when you distribute. And I think any sort of professional advice sector runs this danger. It has this danger. So let's apply the same thing to financial research or advice, right? You've currently got a small number of very highly paid, very professional, very well-respected people.
It's not that small, actually. It's a pretty large number, but go ahead.
But if you make a completely distributed system, now everybody is screaming into the same microphone system.
Okay, so play devil's advocate. First of all, alleging that journalism was better before pre-internet than post-internet can be buttressed by or argued against by saying, well, because you... Okay, right. But I want to get to the premise and then we move forward. So I'm long-winded, but there's a method to my madness. Okay, so it can easily be argued that you thought that journalism was good because you never had competing viewpoints. For instance, you could say, you know something? Everybody from X religion is murderous, hence X religion is bad. Okay, and if you only have one source, right, one primary source, or it's not even primary, one source, period, you tend to consider that a primary source. When you have 48 sources, of which 15 sources are actually X, who are being, alleged to be XYZ, you have more diversity, and then you get to see the flaws and the cracks of what you thought was authoritative. Okay, so with the diversity, you're able to decide what is authoritative. Now, with research, it goes even further. Research, financial research, economic research, value-based research is provable. So you might not know if it's good research or if it was accurate now. This time next year, you simply pull up a spreadsheet and a calculator and go back. How well did he do? Okay, was he right? Was it lucky? Well, to find out if he's lucky, you go back 5 years. When you can empirically prove something, value comes to cruise over time, which makes our team very strong. Over the last 10 years, publicly, we've issued reports. It looked like we're prescient. In reality, we're doing what most people consider conspiracy theory, and I'll tell you what it is. It's called math. Okay, 2 plus 2 usually equals 4. When it doesn't equal 4, we think there's something wrong. A lot of other people don't. Tomato, tomato. Okay, so
and in retrospect, it was always very obvious that everyone knew it was going to happen.
yeah. That's like I was going to make a marriage joke, but I'm not going to do this. Well, go there.
You're actually pointing out the same thing, though, right? You've got a large number of people who don't do this sort of prediction. And even if you're doing this kind of retrospective error correction, some of them are going to be right, just statistically. There's going to be some of them who do something really dumb and happen to be right.
Right.
And they go, oh, yeah, I'm brilliant. That's right. If a million people are doing it, that's going to happen.
Of course it's going to happen. Basic math, though, it's going to happen. Okay? But whether it happens once or not has nothing to do with your ability. We had a tornado about, 2008 in New York, and it really destroyed my neighborhood. I live in Brooklyn. Okay? We don't have a lot of tornadoes in New York. Okay? So because we had one tornado, if you go back the last 60 years and you count the amount of tornadoes, you can get a fairly decent trend of whether tornadoes happen. And it's pretty easy to ascertain that tornadoes are not prevalent in New York. Very, very easy. So over time, with very, very simple observation and math, you can separate the wheat from the chaff. If you're lucky and you called every bank failure, every big Fortune 500 company failure, right, last year, and you did it because it was pure luck, but you also did it for previous 10 years out of pure luck. You know something? That luck is a trend. Okay, so chances are if you did that same thing for 10 years in a row, I'll bet that it'll happen next year. You bet it wouldn't happen next year. Who do you think is going to make more money from a risk-adjusted perspective? Let me help you out.
I think you have a point about people who choose to do the work to vet things, but I think what we've seen on the internet is that is the overwhelming exception.
It's only overwhelming exception in the short term. In the short term. In the long term, listen, in the long term, a fool is rapidly separated from his capital. Okay? In the short term, it happens. Go back to the last big bubble we had. We're having so many of them, actually. The last big bubble, which is still ongoing, is the debt bubble. Okay? You have interest rates that are not low. They're negative. They're below zero. People are getting paid to borrow money. That's a bubble. But there's still people who think that's going to continue on. The bubble before that was a real estate bubble, which I benefit from significantly, actually. Okay? That bubble popped. The REIT was separated from the shaft. Fools were separated from the capital. Big bubble before that, the tech bubble. I would get in and get cab drivers who know nothing about tech, suggest that I buy Yahoo. Mental note, short Yahoo when I get home. So, but, that's why you have to look at things over trends. What happens once is irrelevant. I can walk in and meet the most beautiful woman in the world. She falls in love with me. That's luck. Does it happen every day? Well, for me, it does. But for the average person, no. So it's about trends.
Okay. So the thing is, this sort of small core of highly professional centralized entities, that will get a lot of scrutiny. I mean, for example, to go with the analogy of the press, the way it used to be, when there were 3 television channels that everyone watched, there was a huge amount of public scrutiny, government scrutiny, corporate scrutiny, accountability. That was something that was taken very seriously because one of these institutions deciding to do something that was not in the public interest would be considered to be very bad. But when you spread it out to millions of people, that scrutiny goes away. It's not feasible to do that anymore. It's not possible to do that kind of accountability and scrutiny and checking the evidence, as you suggest, would need to happen.
And the result is you have a better result. You have what you call a market. When 3 companies control all the airwaves, and you still have that in the print media, you have, a journalist or an entity that would be considered authoritarian. Okay? Encyclopedia Britannica was considered the gold standard in encyclopedias. Come Wikipedia, which is about as distributed as it gets. Okay? And you have not one single entity that's authoritarian, but you have millions. And the Wikipedia, despite the fact that a lot of the old school guys don't like it, and I'm not a young dude, I'm almost 50, okay? It has much more information than any print encyclopedia, much more current, updated, usually within seconds or minutes, and much more diverse, and usually much more accurate because it doesn't have one single entity's perspective. Even if the entity is not trying to be malicious, it's still his or her perspective or the perspective of a board. Usually that board is homogenous, is, a flat sheet of paper that's all white or all black.
But doesn't that seem like a different kind of information? Like encyclopedic information is easy to achieve consensus on. Like a research of a very expert, specialized nature, for example, making a prediction that, Lehman is about to fail, that's not something that the masses is going to be very effective at. Right.
Well, the masses.
Most people are not going to accurately call that Lehman Brothers is going down. That's just not going to happen.
Okay. The masses don't have to do it. But, as far as we're concerned, only we have to do it. But the average person, I can guarantee you, if I'd have walked you through the Lehman Brothers balance sheet, right, you'd have saw there was a big problem. 2 + 2 = 49. Okay, I'm not even good at math, I'll be honest. But I remember back in first grade, it wasn't 49. I might draw blanks as to what it was, but it wasn't 49. It was something else, probably one digit. So I'd wager anywhere between 3 and 7, but I knew it wasn't 49. And a lot of this stuff is not rocket science. It's really very basic. Some of it is rocket science, okay? The key is someone has to do the work. Some of it is laborious. We went through Deutsche Bank last year in detail. I called the Deutsche Bank problem last year. Deutsche Bank's financial annual report plus the addendums, 462 pages plus addendums, okay? The average person doesn't have the time to go through 462 pages plus another 300 pages of addendums and then understand what a lot of it says. And most of it's not that complex. It's really not that simple. A third of it is fine print, written in 8 point or 6 point. designed, buried, designed for you not to read it. But when you do find it, you're like, damn, what? I can't believe it says that.
Yeah, so the way it's currently done is a small number of people read it, and other people tell us their opinion about it.
No, that's not the way it's done. The way it's currently done is a small number of people listen to management and they take management's opinion and they question on what's based on what management says. If people read European bank balance sheets, European banks will have a constant run on it. The Italian bank sheets reports read like an absolute horror novel, literally, like Stephen King in finance. And I was reading with my lead analyst, and I was saying, there's nowhere in the world anybody read this stuff. You can never sue Italian banks for fraud because they said it all. Nobody read it, and it's not, you get it, you turn it over from the back and start reading. By the time you get to the fourth page, you're like, damn, it's basically the way the system is. Most people do not want to get their hands dirty. Just like with technology. When you buy Microsoft, have you ever bought a Microsoft Office product?
Yeah.
Okay. Basically, what did the EULA say?
Reads them. Yeah.
Have you read the EULA?
No. Well,
it's not even terms and conditions. It's a EULA, but
I bought it anyway.
A lot of people didn't even read the title, so who knows what the stuff with the bold print. And there's a lot of stuff there. And if you read some of the stuff, I have a 11-year-old daughter. And last year, I think it was last year when this game came out, the Pokemon, I think it was Pokemon Go. She downloaded it. She downloaded it and I downloaded it on my phone to see what was going on. And was just asking for permission after permission on Android. Mm-hmm. I'm like, why do they need all this permission? That software product has access to your camera, your GPS, your SMS. It reads everything. And most people, if they paid attention, wouldn't voluntarily give that up. Or at least some people are, modicum of people. But most people just don't bother to go into it. So we have the machine to do it, and the machine does it at zero margin. And at zero margin, these guys who are operating at 60 and 70%, or actually the margins are lower in banking and hedge funds, but the compensation level is at 60 and 70%, or 50 and 60%.
I think the big question that I have is, so these hedge fund guys are presumably making a decision of some kind, right? This is why they paid the fee. Is they're doing something. It may not be very much.
Okay, well, let's not speculate on why they paid a fee, because they paid a fee because someone thinks that, they can do better than themselves. Most hedge funds can't beat the S&P 500.
If the machine is doing the same thing that they're doing, then you kind of have to ask why that hasn't already happened. But if what's happening is the machine is obeying the advice that it gets from people.
It's not obeying that. It's making a decision based upon advice that it gets from people, just like the hedge fund manager. Sometimes that decision is real simple. He recommended buy, go buy. Sometimes it's a bit more complicated than that, depending upon internal.